Hey fellow investors, in my previous video, the one right after the market started bouncing back from the tariff bombshell, I said I wasn't chasing the rally. That video came just days after Trump's tariff announcement on April 4th, which triggered a sharp sell-off in global markets. The S&P 500 dropped over 10%, and the Nasdaq nearly 20%. Some calm has returned to the market since then, especially after the U.S. administration walked back some of its tougher tariff positions. In fact, just this week, the S&P 500 and the Nasdaq have recovered all their losses from the initial shock. Now, that's a huge recovery in a short time. And to be honest, I didn't expect the rebound to be this strong, this fast. But credit where it's due, the way the bond market reacted, and how the administration toned things down in response, gave me more confidence than I expected. It's not a full U-turn in my view, but I'm definitely less cautious now. Still, I know many of you are wondering, is this a red flag? A potential trap in the making, where the market lures investors back in with a feel-good rally, only to pull the rug when the real economic damage starts showing up? Or is everything really back to normal? Or even better, the start of another strong leg up for the markets? So in today's video, let's break down what the latest numbers actually say, what's really driving the rebound, and whether the recent optimism is justified. Most importantly, I'll share the dividend uncle's take. Am I still on the sidelines, or am I getting ready to lean back in? Even if you don't invest in the US, remember that the performance of the US markets often sets the tone for the rest of the world, including Singapore. Don't worry, US economy shrinks in Q1 and why it matters. But before we get carried away by the market recovery, let's first look at the hard numbers. Because for all the optimism in stock prices, the economic data is telling a more complicated story. And it starts with something we haven't seen in a while. The U.S. economy actually shrinking. The latest GDP numbers for Q1 2025 showed a 0.3% contraction, the first quarterly decline in 3 years. That's not something to brush off, especially when markets are celebrating like it's business as usual. You might be wondering, if the new tariffs were only officially announced on April 2nd, how could they already affect Q1 figures, which only cover up to March 31st? The answer lies in anticipation. By mid-March, there were already growing rumors and unofficial leaks pointing to incoming tariffs. Businesses didn't wait for the formal announcement. They rushed to front-load their imports ahead of time, trying to avoid higher costs later. This created a spike in imports and a record trade deficit, which alone shaved 4.8 percentage points off GDP. In short, it wasn't the tariffs themselves that hit Q1 growth. It was the scramble to prepare for them. And that's just the first wave. The real impact, on consumer prices, corporate margins, and global trade dynamics, may still be ahead.